Welcome back, everyone. In this video, I'm going to be covering everything there is to know about SCHD. And SCHD is an extremely popular dividend ETF. I myself own quite a few shares, about $18,000 worth and 230 shares approximately. And please remember, if you do enjoy this content, give this video a like to help this video get out there to a wider audience, and also subscribe to keep up to date on future content. Now, as I said, SCHD is an extremely popular dividend ETF. I believe it is the 27th most popular ETF by assets under management, and it is only second when it comes to dividend investing to VIG, the Vanguard Dividend Appreciation ETF, which is another ETF that I own. I own quite a few shares. It is the largest position of my portfolio with approximately $38,000 invested. And SCHD is short for the Schwab US Dividend Equity ETF. The fund has a very low expense ratio for what it offers at 0.06%, which is right in line with some of the less costly ETFs there are. Now let's take a look at the fund methodology of this ETF, because this is what makes the ETF so popular in part, and what makes the ETF a very good dividend ETF among dividend ETFs go. So the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. And this methodology is pretty good. So overall, a lot of dividend ETFs have a sort of methodology that is relatively simple. This methodology is a bit more complex. A quick summary: the Dow Jones US Dividend 100 Index is designed to measure the performance of high-yielding stocks in the US with a record of consistently paying dividends, selected for their fundamental strength relative to their peers based on financial ratios. And you can read a bit more about the precise dividend methodology which it uses to select these stocks on its fund page. The methodology, if you download it, pretty much Dow Jones gives a summary of each of its index methodologies. And this one is kind of complex because it gives you this financial ratio formula. And overall, it uses this financial ratio to select the best of the best of high-yielding dividend-paying stocks with a record of growing dividends over time. So some of these simple highlights from the fund page: it offers a straightforward, low-cost fund offering potential tax efficiently. This is because the ETF itself doesn't include a major sector, which is REITs, and a REIT has a different tax basis that you have to pay. So you're not going to see REITs in this ETF, and that is to save you on taxes. The fund can serve as a part of a core portfolio or complement in a diversified portfolio. It tracks an index focused on quality and sustainability of dividends, and invests in stocks selected for fundamental strengths relative to their peers based on financial ratios. We just went over that a little bit. Basically, the summary is you're going to get a diversified set of stocks selected for tax efficiency, growing dividends over time, and also quality in companies. A little bit about the yield itself. Now, since this ETF tries to select higher paying dividend companies, it is going to offer a little bit higher yield than something like VIG, which simply focuses on dividend growth. This ETF currently offers a 30-day SEC yield of 3.91% and a trailing 12-month yield of 3.39%. Pretty much right in line with the fund methodology, how it tracks the performance of the US Dividend 100 Index. This has a total holdings of 103. So pretty much some of these holdings, the three that you don't see in that index, are going to be things like maybe money market funds or cash, which they hold very minor amounts, but they are required to report, which is why you are going to see 103 and not simply 100. As far as the sectors that this ETF invests in when it comes to stocks, you're not going to see a lot of industries that pay low dividends. So things like information technology are going to be weighted quite a bit lower than other industries. You have financials, healthcare, consumer staples, industrials, energy, consumer discretionary, information technology, communication services, materials, and utilities. And financials is the largest sector it invests in, followed somewhat closely by healthcare. This ETF overall is pretty well diversified among sectors. So if there is a sector that you believe you should be invested in, this ETF will likely have it. Although some sectors are weighted quite a bit lower at the bottom, such as utilities, materials, communication services, and even information technology. Those are going to be the sectors that are less than 10% of the ETF as a total. One of the things I like quite a bit about this ETF is its diversification at the top. Now, this ETF has a methodology that kind of prohibits certain assets from being above 4% of the total weighting of the portfolio. And the reason why you see some holdings over 4% is because that there is some drift. In other words, this fund rebalances itself every quarter or so, and during that time, some assets may rise above that 4% mark. So in other words, Cisco Systems increased in value and now it is at 4.11% instead of that 4%. So Cisco kind of did better during this time. And although the fund has that methodology to keep each holding below 4%, you're going to have that happen when this fund rebalances. Now, as far as the top 10 holding goes, you're going to see Cisco, Home Depot, Texas Instruments, Chevron, Amgen, AbbVie, Lockheed Martin, BlackRock, Verizon, and Coca-Cola. So really good top of quality companies with good diversification among industries. And one of the things I like about this ETF and its methodology is certainly at the top, it does have quite a bit of diversification, not only when it comes to the companies and industries, but also the holdings at the top would invest in. There isn't too much drift, with Cisco being 4.11% of the entire assets under management of the ETF, and Coca-Cola being 3.95% of the total assets in this portfolio. Now, to give you some contrast here, if we look at another popular dividend ETF, VYM, the Vanguard High Yield Dividend ETF, which somewhat has a similar investment methodology, this fund has different weightings at the top, and there is quite a bit of discrepancy between the top holding, which is JP Morgan Chase, and Bank of America, with Bank of America having 1.66% of the total assets and JP Morgan having 3.53%. So in other words, the top holding is twice as much as a total percent of assets under management in the fund versus the top 10 holding, which has about half of the amount there. And you are going to see that discrepancy kind of mirrored in other holdings too, with Walmart being 1.7%, and that is the top 9th holding, and that is still going to be under half of the top 1 holding. In other words, SCHD has a good amount less of overall top heaviness between the top 10 holdings as a whole. And I exported the total holding list to Excel to give you a better breakdown of the holdings that it invests in and also the weightings of its holdings as a whole. So pretty much you're going to see in this column the name of the stock itself, and then in the left column you're going to see the percent of total assets. And you don't really start getting down to things that are under 2% until you reach the 20th holding here. And that is very good because, again, it speaks to the lack of top heaviness. You usually see like a large portion of value in the top 10 holdings, but with this ETF, you don't see that as much overall. You see quite a bit of good number of holdings, even going down to the 20th holding as an entirety. So you are going to see good diversification in weightings as well, unlike a lot of the ETFs out there. Now, one of the big concerns with this ETF is that some people don't think it is diversified enough because it only has 100 holdings, but in my opinion, that offers a good cross-section of the stock market. And if you are going to focus on dividend companies as a whole, I think 100 holdings is quite a bit diversified enough. And if you're investing in this ETF and you're worried about diversification, I don't think it is that poorly diversified, even though it only holds 100 companies, especially if you do pair it with another ETF itself to further diversify. And even if you don't pair it with another ETF, as the highlight suggests, the fund can serve as a core to a ETF or investment portfolio. So again, lack of diversification among hundreds of companies isn't so important. 100 should be good enough so that you're getting the best of the best and not including maybe not so good of companies. And as far as dividend ETFs go, this fund has performed relatively well over the past 10 years. So a dividend ETF isn't necessarily orientated to really high growth. It is to pretty much grow your dividends over time and also for high income. And over the past 10 years, this ETF has grown about 100%, which is really good, especially considering other comparable dividend ETFs. If we take a look at VYM, you see that it grew 78%. So this ETF has lacked by about 22% over the past 10 years compared to SCHD. And as far as dividend growth goes, this ETF does very well, of course, because one of its requirements is that it invests in companies that have a history of growing dividends over time. And this ETF offers an average 5-year dividend growth rate of 12.88%, and it has grown its dividend for the past 12 years consistently. So you're going to get a high rate of dividend growth and also consistent dividend growth over time. And as far as the dividend goes, every quarter you're going to be getting paid a dividend. This is a quarterly paying dividend ETF, so you're going to get paid every 3 months. And as far as the previous history of the dividends go, you are going to see some variation quarter to quarter because of the payout schedule of each company is a bit different. So if we look in these cash amount column here and then also the ex-dividend date, we are quickly going to go down and give you a rough idea about how well this ETF has grown its dividend over time and also the overall payment consistency of this ETF. And before I do that, I want to just give a quick shout out to this ETF, which has grown its dividend quite a bit year over year. In June of 2023, it paid a dividend of 66.47 cents per share. And then in June of 2024, it paid a dividend of 82.41 cents per share. So as you can see, the fund does a great job of growing its dividend over time. And I am just going to scroll down a bit to show you that dividend grow over time. Overall, as you can see, a few years ago, it paid quite a bit less. And then if we go back even further, it paid even less. Now, the fund is managed by Schwab, one of the largest financial services companies in the United States. And the fund has been around since 2011. So it has about a 13-year history of performing well, while the index that it tracks has been around a little bit longer overall. So there's a good history of how this ETF and its holdings would provide over a long period. Again, this ETF rebalances every so often, so the holdings definitely will change. But just to give you an idea, the methodology overall is solid and it performs decently among various economic conditions. So I hope that does give you a good overview of this ETF, why it is so popular among dividend investors, and why it is a great ETF to hold as a core of your portfolio, or also a complement with other ETFs as a whole. One thing about this ETF is that some people don't like it because it is tax inefficient, because of course a higher dividend, especially if you hold this in a taxable account, will drag your portfolio's performance because of tax drag. You have to pay any sort of dividend tax that you owe to the government. And also because this is a dividend ETF and its holdings, it's likely also not going to appreciate as fast as something like the S&P 500 or any other growth ETF, because its investment methodology doesn't really go for growth. It goes for high yielding dividends and also dividend growth. Remember, if you did enjoy this content, give this video a like to get this video out there to a wider audience. I greatly appreciate it. And also subscribe to keep up to date on future content.